Hello and welcome to the monthly recap. This is the month ending today, June 30th, 2026. I hope you all had a wonderful month. I hope you had a wonderful weekend. I hope you have a nice 4th of July weekend ahead of you. So, let's get into June. And I know, and I know, I always say it. I say it every single time. Like, it was a busy month, but June was a wildly busy month. There's just no other word for it. It was so crazy. We're going to talk about Iran, the memorandum of understanding that was signed, the current implications, the fuse that has currently been lit. We got a 45-day window to negotiate some pretty significant points of contention. So, very curious. I mean, even this last weekend, there was still some fighting going on. How solid is this ceasefire currently, and how's it holding up? Talk about inflation. It's getting out of whack, but mostly driven due to oil prices. We'll get into that quite a bit. The labor market. Labor market is showing what I'm calling confounding resilience, and I'll talk about exactly what I mean by that. Some signs of huge strength, some signs of kind of underlying weakness and confusion. Like I said, confounding weakness, resilience. So get into that a bit. New Fed chair's first meeting, Kevin Warsh's first meeting. It was quite a big one. He has a lot of things he wants to accomplish. He is, setting the bar pretty high. So kind of exciting to see there. And then mortgage rates as a whole, end of the month right around 6.49%. It's been a super volatile month, as they honestly kind of all have been since February 28th. Anyways, happy Father's Day, Juneteenth, Pride Month, and then, obviously, 4th of July right around the corner. So let's start talking about Iran. Okay, so March was military operations, as we all knew. April was ceasefires, blockades, and talks. May was diplomacy, patience, and a lot of frustration about how quickly diplomacy was working. And then June, honestly, was like 2 steps back and then 2.5 steps forward. It started off with some offers being exchanged between both parties. Neither was acceptable. The U.S. wanted more nuclear concessions. Iran wanted more money. They wanted $24 billion in frozen assets to be released so that they can start to rebuild. It's going to be kind of interesting in just a second here when we look at the memorandum of understanding that was signed. But those are two big question marks still. So we shall see what happens. Attacks renewed between the U.S. and Iran, Israel and Lebanon, and then Iran and Israel. So there was a lot of fighting that was still occurring in June, especially in the earlier part of the month. Finally, ceasefire took hold again, and then it crumbled again. U.S. Apache helicopter was downed. The U.S. renewed their attacks in response to that, and then, Iran kind of did the exact same thing in reverse. On June 15th, the Memorandum of Understanding was agreed upon. This basically gave them a longer ceasefire window to negotiate some pretty significant terms. Okay, so it's certainly not an agreement as much as it is working towards an agreement. It is a stepping stone, and really that's all it is. It's definitely a stepping stone. But 60-day ceasefire was agreed upon. Again, like I said, like even this past weekend, there was fighting still going on. So how sure is that ceasefire? Only time will tell. The opening up of the Strait of Hormuz, that is a pretty significant change. Ships are now going through the Strait of Hormuz, not quite at the same rate that they were before, but that's also kind of to be expected. There was such a backlog. There was such kind of a log jam that occurred. It was going to take some time. And then I think, ships are just being a little bit more cautious because of their surroundings right now. And then it was agreed that no tolls are going to be charged. Long-term agreement still has to be negotiated, and that has to basically happen over the next 45 days. Would not surprise me at all. In fact, I'd expect it that they don't get all the pieces buttoned up by then, and they probably end up kicking the can even further. That's, I guess, one of the side effects, maybe perks, if you want to call it that, of this, is that they can kind of keep just kicking that can further down the road while they continue to hammer out some of these details. Now, a lot of key questions remain, and there's a lot of key questions that remain. Restrictions on enrichment on Iran's side with regards to uranium enrichment. Are there going to be any restrictions in place on that? What happens to the Iranian current stockpiles of enriched uranium? Do Iran's frozen assets get released? Again, that $24 billion is still a question mark. But in that memorandum of understanding, $300 billion in U.S. money was going to be given to Iran so that they can rebuild their infrastructure. But it's a question mark and still a pretty significant question. Who is paying and how much? Right now, it's just been categorized as 300 billion from the U.S. and their allies in the area. Like, well, great. Who's on the hook for how much money? That's a pretty significant data point that we still got to figure out. Does Israel abide by this agreement and the ceasefire? Again, fighting happened just this last weekend. But Israel, they were definitely, involved in the fighting and definitely involved in this conflict. And yet they weren't really brought to the table to discuss the memorandum of understanding. In fact, they've come out and said, like, we were not a party to that conversation. So, all this could go sideways very, very quickly, depending on what Israel decides to do. And then can peace stick when conflict is sticking as well? That's a big question. So a lot of questions still to be answered. We are, again, a step in the right direction. I said 2 steps back, 2.5 steps forward. Yeah, if there was an actual agreement, it would have been 4 steps forward possibly. But the fact that it's just a stepping stone towards a longer term agreement, I'm going to call it 2.5 steps forward. So just barely making any progress. But, we'll take whatever progress we can. Because of this. Freaking inflation, man. Freaking inflation. It's crushing people. I know it's really, really rough right now. This comic kind of sums it up pretty well. Gas price, if you have to ask. And then fill her up, and he's literally just holding out a cash bag. Like, just dump it all in, man. It's whatever you got. So yeah, inflation was pretty rough. We actually saw kind of frown upside down here. We saw a little bit of progress only insofar as the core readings were not nearly as bad as the headline readings. Okay, so the headline readings are all in inflation. Oil prices, food, energy, everything included. What is the headline inflation? What is the all-in inflation figure? Okay, and then we get the core reading, which is when you remove volatile food and energy from the inflation figures. What is that actually doing? The reason they have that core figure is honestly for exactly times like this where we have one thing that is just kind of running rampant and it's not expected to run rampant long term. Okay. That happens with food prices. We saw it happen with eggs. We saw it happen with poultry and chicken due to, bird flu, right? Well, they don't want the same thing to happen with regards to, hey, look, there's, conflict in the Middle East. Oil prices have jumped and now all in inflation looks really high. Now, let's remove that variable from the equation. What does the core reading look like? What does inflation look like when we remove those volatile food and energy components? Now, as I've talked about before, over time, the rise in energy prices will still bleed over into core inflation because everything has to get shipped, right? Even if you're not necessarily paying directly for the gas, it still gets factored into the price of goods, right? So over time, it does have a bleed over effect. The reason I said frown upside down is because we're still seeing for the most part, it's starting to bleed over a little bit, but for the most part, it's really kind of separated. Okay, the headline is really reflective of oil prices increasing, and the core reading has somewhat been isolated or insulated from it. Okay, so let's start with consumer price index, CPI, Fed's second favorite measure of inflation. It does measure inflation as you and I, us consumers, feel it. Okay, so the headline figure, again, all in for May was up 0.5%. No way around it. That's a huge number. It sucks. The yearly figure increased from 3.8 to 4.2%. Again, pretty dang rough. Okay, no real sugarcoating that. But like I said, the core reading this month in particular was insulated. And we didn't see that necessarily happen last month. And last month we saw a lot more of that bleed over effect. This month, not as much. So for May, the core reading only came up 0.2%. The yearly increase from 2.8 to 2.9%. Again, getting further away from the Fed's long-term goal, they want core CPI and core PCE to get down to 2%. But again, for the most part, kind of insulated from it. Okay. Producer price index. Inflation is businesses feel it. That was really, 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 really bad. I couldn't say really long enough. I honestly probably could have just baked in an entire minute long of good reallys, and it still would not have been sufficient. The headline for May came in up 1.1%. 1.1%. Businesses are now paying 1.1% more for their goods than they were before. In a month, in a month. Like, that's a figure that could be for an entire year, and it was for a single freaking month. Ouchie wawa. The yearly figure increased from 5.7 to 6.5%. Rough, 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 rough. No way around it. Again, though, frown upside down somewhat. The core rating was, again, pretty insulated from it. Yeah, 0.4% is still a high reading on the core figure, but it's so much lower than the 1.1%. We're going to take it as a win. And the yearly figure actually remained at 4.9%. So, again, not great news generally, but at least the core is been and is insulated from the rise in energy prices. Because they did see the energy prices jump like 23% in May. So there's no joke there. All right. Personal consumption expenditures. We got two because last month when I was recording this, I didn't have those figures just yet. I had to release it a week early because I was going on vacation. Back now. So let's get caught up a little bit on PCE, personal consumption expenditures. This is the Fed's favorite metric. So for April, came in up 0.4%. The yearly figure jumped from 3.5 to 3.8%. Core, again, fairly insulated. It only came in up 0.2%. The year-over-year figure went from 3.2 to 3.3%. So again, same story. Headline, high, core, fairly insulated, not as much of a change there. For May, headline came in up 0.4%. The year-over-year figure jumped from 3.8 to 4.1%. Ouch, that stings. It stings. There's no way around it. Core reading came in up 0.3%, so a little bit hotter than expectations, but not terribly. The market didn't really react too much to this figure either. And then the yearly figure did go from 3.3 to 3.4%, which is, again, not going in the right direction. The Fed wants that rate to get down to 2%, but it's not as bad as it could have been, especially when we've seen on the headline figure. So that is a story on inflation. More on inflation a little bit here because we're going to talk about the Fed meeting, and they did talk about inflation a fair amount. Let's take a look at the, again, confounding resilience in the labor market. So we got three reports effectively. There's a couple more minor reports as well, but we really got three reports. But let's start with BLS, Bureau of Labor Statistics, okay? The first of the three. 172,000 job gains in May. Expectations were only for 85,000. More than double job gains. This is an absolutely huge number. It was a fantastic number. Great news there. A lot of red on the previous slide with inflation, but a lot of green on the employment front. And not just that, this was extremely strong. More than double the job gains for May. Great news. But even better, arguably, is the fact that March and April, which were already pretty decent, they were revised up by a combined 93,000. Like, wow, this turned a really good jobs report into a simply great jobs report. Fantastic news, good stuff. Unemployment rate did stay stable at 4.3%. That's a little bit misleading only because the unemployment rate can remain unchanged for a number of different reasons. Maybe people are leaving the workforce or joining the workforce, or people are passing away. That's one way to say, I guess, leaving the workforce theoretically. But there's a lot of reasons the unemployment rate can change. So the fact that we didn't see it improve does not necessarily mean a bad sign for the economy. It simply could have meant, hey, there was a lot of graduates graduating college. They are now joining the workforce. So we didn't see a change there, even if there was really robust hiring, something like that. ADP employer report. Again, came in pretty dang strong. Not quite as strong as BLS, but came in pretty strong. 122,000 job gains in May. Expectations for 117. So again, they beat expectations. I was also really good to see small businesses were the largest contributor. That's really good news because small businesses tend to be exposed, vulnerable to a weak economy, right? If there's a weak economy and people aren't spending money, it's going to be really hard for a small business to get up off the floor, and definitely hard for them to hire new employees, right? They tend to be a little bit more aware of economic conditions. Big businesses, they have the luxury of being able to play somewhat of a waiting game, and they can take a longer term viewpoint. Small businesses, they're typically taking a very short term viewpoint because, yeah, they're a little bit more exposed. That was great news to see, small businesses. However, it is worth pointing out 57,000 of the jobs were gained in education and health services. Why is that important? Well, education and health services are not sectors of the business, of the industries that are really exposed to economy. Okay. People are always going to need to get educated. People are always going to get sick and ill, right? So those are two sectors where they tend to be, again, pretty insulated from recessions, economic uncertainty, that kind of thing. They tend to be pretty strong gainers regardless. So to see, a pretty sizable chunk of those still coming from education and health services paints a little bit of a different picture. But generally speaking, again, very strong numbers. Now, the reason I said confounding resilience, right? Because if you look at these numbers, you're like, wow, these are really, really great, fantastic numbers, well done economy. But then when you start to look a little bit deeper, there's some confusing parts of it for sure. So there was 97,000 job cuts in May, which is very high. That's worth keeping an eye on. AI was the number one reason given for those job cuts, and that's the third month in a row. So again, confounding resilience. We hear about people losing their jobs to AI, and they did account for 41% of the job cuts. And we also see significantly, pretty high job cuts as well. So is it strong as the numbers would point, or is it, a little bit weaker because of these kind of things? We also saw job openings increase. Again, that's kind of adding to the confusion, the confounding piece, because it was not just an increase, it was a pretty sizable increase from 6.88 million to 7.6 million jobs. So, oh, great. So the economy is doing well, but there's a lot of job cuts and AI continues to chip away. Is the economy doing poorly? Is it good, positive? It's just very confusing and confounding. Adding to the confusing piece as well, the hiring rate fell from 3.5 to 3.2%, which says, hey, look, there's a lot of jobs out there, but employers are taking their sweet time to hire people, okay? For whatever reason. It could be that, yes, they have these jobs posted, but they don't really have to fill them. Maybe they're getting filled by AI. Maybe they're taking their sweet time because they're like, look, we know there's some economic uncertainty out there with oil prices, energy prices, everything else going on. Like, is this the right time to really be building our business? Like, we got the jobs posted, but are we really energized at the prospect of filling them? Or are they posted just for the sake of having them open? But seeing that hiring rate fall is not a good thing. It points to, again, some underlying weakness there. Quits rate. Those who feel empowered to quit their jobs. Typically, people will do that if they're getting actively recruited. Clearly not the case if their hiring rate is so low or the quits rate is so low. Also, they're more likely to quit their jobs if they feel like they have better prospects out there, if they're going to get paid more money. And clearly that's not the case if people are quitting at a much lower rate. Bird in the hand is worth two in the bush. I'm only going to go seek that other opportunity if I do believe the pastures are much more green. And right now, people don't believe that. It's the lowest rate since 2014 when you exclude COVID. That's a pretty sizable range to go off of. So quits rate is low, hiring rate is low, a lot of job cuts. AI is still leading to the jobs, accounting for 41% of all job cuts. And again, third month in a row where it's the number one reason. So again, that also points to kind of a weakness. But then we also see some really strong numbers. So again, kind of confounding resilience. Not sure exactly what's going on there. Time will tell. It's also going to be very curious to see how long AI continues to chip in. Is this just, a boom at the moment, or is it something that's going to be, seen kind of going forward? Fed meeting. So June, big Fed meeting. We got another one in July as well. Although the one in July at the end of the month is not going to be nearly as significant. But let's take a deeper look at the June 17th meeting, because it was a big one. So Kevin Morse, like I said, it was his first meeting. Okay, first meeting as the new Fed chair. In March, if you recall, there was one dissenter, so one person disagreed with the decision. And April, 4 dissenters, so a lot more division. And then June, they showed a lot of unity. They really kind of all stacked hands and agreed with Kevin Warsh and said, look, we're not going to start off with conflict. We like some of the stuff you're saying, some of the things you want to do. So let's give you a chance. So there wasn't any dissenters in June. It's good to see a more unified Fed. The more unity there is, the more they can probably accomplish, I hope. So Warsh did double down on his 2% inflation target. More on that in a sec, though. Like, he did talk about, hey, look, we will get down to inflation of 2%. It's not a question of if, it's a question of when. But he also commented that he's really more concerned about the number in front of the decimal point rather than the number behind the decimal point. So if inflation is at 2.9, he's focusing on the 2, not the 0.9. Which is all fine and dandy for now. But he does want to get down to a 2% target. And he also realizes, like, look, we're not there. He also talked a bit about changing what metrics he's going to use on inflation. More on that in just a second. He signaled that forward guidance is not important. That was a pretty big shift. So when the Fed has these larger Fed meetings, these ones that are in bold here, okay, and the June one was one of them, they come out with what they call a dot plot, where they put out a little chart, and I'm going to show you here in a second what it looks like. They put out a little chart, and each Fed member puts down their dot. Kevin Warsh basically said, that is a waste of everybody's time. I do not like issuing forward guidance. It's unreliable. It doesn't really tell you much because circumstances change, variables change so quickly. And then what we find is the market is reacting now to what the Fed is saying rather than what the data says. And the data is way more important than what the Fed says because the Fed is put in front of the press way too often. They're marching out there. They're talking out of their third point of contact, as my dad would say. You can look that up. That's a military thing. It's not really offering any substance or benefits to the market. So, he signaled that forward guidance is not important. In fact, so unimportant that he didn't even put down his own dot on that dot plot. Like when we get to the dot plot, you're like, wow, there's one fewer dot on here than normal. Yeah, he literally didn't put his dot down. He was like, I refuse. So that was interesting to see. He wants real-time data. He's sick of this delayed data, all these massive edits. He also wants less communication from the Fed. And this was the biggest takeaway. He wants to create 5 different task forces, and he's already well on his way. He wants to have all these completed by the end of the year. So ETA end of the year. So what are the 5 task forces? One, he wants to streamline Fed communication. Expect changes there with regards to the communication frequency and their projections. That's a pretty big shift. Fed balance sheet. He wants to take a deeper, longer look at the Fed balance sheet, review the benefits and risks and composition, and alternative frameworks as well. So he's going to look at maybe ways to shake up the Fed's balance sheets to make things, I guess, for lack of a better term, more balanced. It's going to be interesting to see what he decides to do there. First things first, he's got to create these task forces that really have to kind of like analyze all of this, and then he's going to start to come up with some actionable items, hopefully. Data. He wants to evaluate new data. He's not happy with some of the, CPE and all that. I think he's getting a little frustrated with some of these data sets and how much they rely on them for pretty significant decisions. So he's going to evaluate new data, take a look at some changes that could be made there. He wants real-time and actionable information. Speaking of AI, he wants to review productivity and jobs in the era of AI. He wants to survey the pace and impact and scope of new technologies. And really what he's talking about there is AI and how it impacts jobs going forward. Inflation, and I mentioned as well, he wants to review the Fed's inflation framework. What are the drivers and ideas to deliver price stability? Basically, keep inflation in check in an economy that's constantly changing. So, he's creating currently 5 different task forces. He's hoping to have all these ready by the end of the year so they can really do a deeper dive on all of these different pieces. Now, let's take a quick look at 3 pieces of data from the Fed. So let's look at their core personal consumption expenditures expectations. So these blue bars here are the June projections, okay? And this little dotted line here is what they were projecting in their last significant meeting, another Fed meeting associated with the survey economic projections. And what you'll see here is that in March, the brunt of the members were expecting inflation by the end of the year to get in a range of 2.5 to 2.8%. If you recall, the conflict in Iran was just starting. Nobody was sure how deep it was going to go. Nobody was sure how high oil prices were going to go. Well, the Fed changed their projection. Okay, so they said, hey, look, instead of thinking like 2.5 to 2.8%, we're now thinking closer to like 3.3, 3.4%. That's a huge shift from the Fed's perspective. It does also speak to Kevin Warsh's concern of like, look, why do we spend so much time on these stupid projections when they can change so freaking fast? March to June, expectations shifted drastically. Same could be said for the unemployment rate. And for better or worse, like, great, they're now expecting inflation to get worse. They're also expecting the labor market to be much more resilient than they were expecting. So again, same exact thing here. March, this little blue line, they were expecting the unemployment rates by the end of the year to get down to like 4.4, 4.5%. Now they're expecting that to get down to 4.2 to 4.3%. So they are expecting, again, a more robust labor market and higher inflation. And again, these are just highly volatile figures. All right, this was the one that kind of riled up the markets a little bit. This is my last slide. And then we'll talk about what's on the docket for next month. So this is the dot plot. Okay, so like I said, every member puts down their dot plot. Well, in March, the current level for rates is right here. Okay, so what this says is that most members were expecting one rate cut or more. Okay, back in March. Well, this is still that current level, but what we're seeing now is we're seeing things shift in the opposite direction. Again, one fewer dot than usual because Kevin Warsh decided not to do it. But what we saw here is we saw, hey, look, there's multiple people now that are actually predicting rate hikes, not rate cuts, but rate hikes by the end of the year. This is the one that really kind of upset the markets. The markets were like, oh no, what's going on? What's going on is inflation, right? I also am not quite sure whether or not this actually comes about. If they, the conflict in Iran eases up, they start to come to some really strong agreements, oil prices stabilize and come down even further. That's going to be deflationary. Inflation is going to improve. As inflation improves, this would change once again. The only reason they would look to hike rates is to curb inflation. If they can get their hands wrapped around it, with just time and the benefit of Strait of Hormuz being opened up, probably not necessary. So again, that's again speaking to the Kevin Warsh's idea of like, look, these projections are BS. They're not really helpful. I can tell you what you want to hear in March, but it's going to change in June. It's going to change again in July. It's going to change in September. So yeah, it's interesting nonetheless. But the markets did not like to see this chart. They did not like to see the fact that rate hikes might now be on the docket. All right. So, how do negotiations with Iran go over the next 45 days? A lot to accomplish. Like I said, it would not surprise me at all to see them kick that can down the alley so that they can keep punting, because 45 days is not a long time to come to some, agreements on a lot of these big sticking points. Inflation and jobs going to continue to be under the microscope. Does the labor market continue to stay strong? Does inflation continue to tick up? Does inflation start to stabilize and come down? Going to be very interesting. Another Fed meeting in July rather, at the end of July, but it's not nearly as significant as the one we had in June. And then what surprises does July have in store? There's going to be some. Who knows? All right. I think that's it. Thank you all so much. I appreciate you greatly. Thank you all for your continued referrals. It means the world to me and my team, literally the lifeblood of our business. So thank you, thank you, thank you, thank you, thank you. We never take them for granted. If you ever need anything at all, hit me up. I appreciate you all, and I will see you next time. Thanks. Bye.